In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, welcome back, Market Rebels, and to all of our options traders out there in YouTube land. And we've got Scott Thorstensen joining us for the first time in a while. Scotty, welcome back.
Good to be here, Bill. Thanks for having me.
Of course. Great having you here. And of course, everybody knows Stu. And little kind of sideways last week here, guys. I think we got a green candle I saw kind of going into the close on the SPY hammer, and then a red hammer going into the Qs. But again, kind of a dicey day, just kind of a sideways day.
Dicey day, late rally, Dow rally, late afternoon Dow rally here. But yeah, it keeps trucking along, doesn't it?
It does. So I know that both of you do a lot of coaching, and Stu and I get a lot of questions like this in Q&A, but we find that there is a topic, should be a very simple topic, that everybody should know. Everybody is definitely subjected to it. And we find that there are so many questions and myths and fallacies about it. And that is about exercise and assignments. So I know you guys get that. So we're going to talk about that today. That's the setup for today. That's all I'm going to tell you, a little hint right there. So let's get started with our Chalk Talk. Now, for anybody who's new, Chalk Talk is a little thought-provoking question. At least it's supposed to be. And we would ask you to jot down your answer. Think about it for a moment. And then at the end of this, we will come back and give you the answer. So here's your question for today. We've got a stock trading at $99.90. We're on expiration day. So we're going into the closing bell here. And you're short. Yep, you're short the $100 call. And the question is, will you get assigned? I know why you're laughing.
I love that.
We hear this all the time. So what do you think? Yes or no? So
down, commit, give it some thought.
Commit to an answer. All right, so let's go ahead and take a look at this. It can be actually a very involved topic. Depends on how deep and involved you want to get with it. But we're going to talk about some of the key points that everybody should know, and that is with exercises and assignments.
And it's not a mystery. It's not some magical wizard behind the curtain. It's a process. The issue is that very few people actually understand the process. And what goes into it, and how you get assigned, why you get assigned, what's the process of getting assigned, why you'd want to exercise or not exercise. So the three of us thought we would take some time today and just kind of chat about it. Yeah.
And I think we're going to get some nice offshoots on this too. Scotty and I were talking about earlier, maybe doing cash indexes, American style cash indexes like the OEX, and some of the problems that they can pose just for, again, nuances about exercises and assignments. Yeah, so let's start off at the very top, rights versus obligations. One of the most important points that you can understand as an options trader is that you're either dealing with a right if you buy or you've got some kind of an obligation if you sell. So here's the way it works. Option buyers pay money. And one of the reasons you're doing that is you are gaining the right to choose to either buy or sell. Right to buy in the case of a call, right to sell in the case of a put. Now, the option sellers receive money, and this is the part where everybody gets hung up on. They say, oh, I'm receiving money. But they forget that they have a potential obligation. There's a reason you're getting paid for that.
Bill, I have a question.
Absolutely.
If I'm a seller and I receive money, does that mean I can generate income?
Another one we hear a lot. I know that you and I think Scotty feel that you're not really generating income. You're just putting on another trade and accepting a risk in exchange for cash. And it's kind of a myth to say that it's generating income. You're subjecting that cash to risk in exchange for potential rewards.
Yeah, people often just, well, hey, I got money coming in, so I'm going to like create this cash flow that's going to, make me richer than I am now, or just, create some cash flow money. It's not free money.
You have to remember there's an obligation attached to it.
Not free money. You're getting paid for something. You're getting paid for an obligation. You're getting paid for service. You're getting paid to provide something for somebody else. And that's why you're getting paid. So it's not for free. And that's all. So, okay, go ahead.
Be careful about generating income.
Yeah.
So those are the basics
terrible
of rights versus obligations at the very most basic level. That's what the options market is. It's a market for figuring out who wants to accept an obligation, who's willing to accept cash, and who doesn't want some risks and is willing to pay money to avoid those risks. And without the options market, it'd be a very difficult process to find out who's in the best position to accept those risks. And now all we have to do is look, do you want the call side? Do you want the put side? What are the prices? And we can figure that stuff out immediately.
Can I let you know afterwards which one was the better one?
You can.
Okay. Thank you. Carry on.
Now, let's take a look at it grammatically, or from a diagram. We got calls and puts across top, buyer and seller on the vertical here. So let's look at this first cell. If you buy a call, you have the right to buy. And if you buy a put, you have the right to sell. I like to show this to the new traders because most people understand this, that a call is the right to buy and a put is the right to sell.
Right to buy or sell shares.
Shares, 100 shares, technically, at least in most cases.
Most cases, right? The underlying contract exhibits the right or the obligation to deliver 100 shares.
Yep.
Which it will be unless otherwise stated.
Yep. So they get a little hung up, though, on the sell side. And so this is an easy way to figure it out. So once you start out with what you know, in other words, the buy side, now just flip it. You're on the opposite side. So what's the opposite of the right to buy? Would be the obligation to sell. Notice the opposite of right is obligation, and the opposite of buy is sell. So again, that's an easy way to figure out the right answer, and then over time, you'll just immediately say short call is the obligation to sell. What about the put here? The put buyer has the right to sell, so the put seller must have the obligation to buy. Opposite of right is obligation, opposite of sell is buy. All right, so again, that's an easy way that you can figure out rights and obligations. So if you are long an option, you have the right to exercise. You don't have to, ever. But if you sell an option, you might get assigned, in which case you do have an obligation. You have to deliver.
All right, let me jump in here for 1 second.
Sure.
Bill and I and Scott, we try and get people to say, look, don't memorize this. Understand it. Then you won't have to memorize anything. Just kind of get the idea here. As far as this, what Bill has up here, look, everybody, I think pretty much, if they don't know after day one, they know that buying a call gives you the right to buy the stock. And that's all you really need to know. Because if you know that, you can figure out the other ones like Bill's doing here. It's just the other side of the trade. And I always tell people to just think about the other side of the trade. It's really going to help bring perspective into it. If you're doing one thing, what's the other side of that? And that'll help you understand more about what you're doing and what your potential risks are for the trade that you're putting on.
Yep. And you're right. You could look at, if you just understand that the buyer has a right and you know that the call buyer is the right to buy, well, the put buyer, you must say, okay, put buyer, it's a right of some kind. Well, it can't be the right to buy because that's the call. So that would be a clue. It must be the right to sell. And then you can figure out the sell side from there.
Yeah, it's just the other side of each trade.
Just take the other side of it, right? And it will all fall into place. Now, within options, there are a couple of what are called styles, right? There are two types of options, calls and puts. But within this, we have two styles. And one style is called American, and the other is called European. Now, these have nothing to do with the continents, and they're just names. And it's kind of weird. I've actually done a lot of research on this. It's not really even clear where these names came from.
Where did they come from, Bill? Do you have any idea?
I have no idea.
Me neither.
The thing that you don't want to do is to think that, oh, we have American style here, and over in Europe, they have European style. Not true. We have both here. They have both there. They are just names.
The vast majority of what's traded in both places is the American style.
In most cases, right, if you had to guess. But if you have an American style option, it can be exercised at any time. Mm-hmm. So I could buy a 30-day option, and I could turn right around and exercise it in 1 second. I could buy a 3-year leaps option and turn right around and exercise it. Not saying it would be a good idea to do it. I'm just saying that you could.
Could you exercise it, Bill, if it was out of the money?
We're going to talk about that, but yes, you could. You can exercise it at any time for any reason.
At any time, that's right, for any reason at all.
It's a right. Now, of course, the buyer...
You have the freedom.
You have freedom to exercise. That's a good word for it. It's the freedom to choose. Of course, the buyer is only going to exercise if it's advantageous. So that's why we would generally, although there's exceptions, but we would generally say that you're not going to see an out-of-the-money option exercised. But that doesn't mean it can't happen. And we'll talk about why it might.
Or maybe it looks like it's out of the money, but it's really not.
That's a whole other argument. Absolutely. Yep. So now the European style, the counterpart, may only be exercised at expiration. So you got to wait for that expiration bell to ring, and then you can exercise. Now, off the bat, a lot of times traders say, well, gee, that's a horrible deal. You know, what if the stock goes up or down and I need to get out? That's a different story. That's not exercising it. Both styles, American and European, may be closed at any time. Mm-hmm. But to exercise it, that's where the distinction comes in. And in most cases, there's not going to be a big difference between these two mathematically.
Bill, does that mean if I have a European style option and I want to sell it before the expiration date, I can actually go ahead and do that?
Oh, you can absolutely close it at any time. Correct.
How about if I have an American style option? Can I sell it at any time?
Yep. In that sense, they're identical. Yep. You can sell them you can open them and close them at any time.
Anytime between the hours of 9:30 a.m. and 4 p.m. Eastern Standard Time, when the exchanges are open, there is a market to trade.
There's a market trade. You can close it at any time. So that's important to understand, because I've heard a lot of traders that get a little queasy and go, oh, I don't know if I want to hold it all the way to expiration. That's not what that means. It just means you can only exercise it at expiration. Mm-hmm. Okay, so those are some of the basic definitions we're going to work with. And as always, quick little plug here for marketrebellion.com/get started. If you are new to options, or even if you're not so new, lots of great information on there, great videos, courses, articles. Check it out. You want to be real careful where you get your information from, but we can assure you there's some very good, solid information. So check out marketrebellion.com/get started. All right, so let's start with long options. So here we go. Option buyers may exercise at any time for any reason, as Stu just said, even if out of the money. Now, again, you might wonder why somebody would do it, but at this point, it's not important. We're just going through the definitions. So get it out of your head if you say, oh, they can't exercise it because it's out of the money. That is not true. It could be exercised. Now, if you choose to exercise, what do we have to do? Submit exercise instructions to the broker. Now, it sounds like a complicated process. It's probably just going to be clicking
a few buttons.
Click of a button, pick up a phone call, say, hey, I want to exercise my call. That's really all they want to do. It's really to confirm. Usually what it's going to be is, all right, you're going to exercise this
call for Microsoft. Do you recognize you're going to buy 100 shares of Microsoft at the strike, whatever it is, 350? It's going to cost you 35,000. Is that what you want to do? Yes. Bang, you're done. That's all. That's really all it is. It's just a confirmation.
Right. They're not going to ask you why. They're just going to say, "Is that what you want to do?"
Not got to fill out a bunch of paperwork and notarize it and stuff. It's just a click of a button.
Yeah,
and that's all it is. And it's guaranteed.
That would be called an exercise by exception.
But we're going to get to that.
Oh, sorry.
So now, when you do that, you're going to take physical delivery of stock. Again, let's say shares of Microsoft, ETFs, exchange traded funds, or ETNs, exchange traded notes. Most of the options out there, you are going to take what's called physical delivery. However, most of your indexes are going to be cash settled. Now, of course, that's a difference if we have SPY. SPY isn't tied to an index, but it's an ETF, so you would actually take shares of SPY. But if you did it on the SPX, it's going to be cash settled.
Cash.
So those are some of the nuances. Now, most brokers allow these exercises up to 5:30 p.m. Eastern time. But what's important here, Stu and Scotty, every broker is allowed to make rules.
They have their own rules. Like your broker might say, you got to be done by 3:00.
Oh, yeah. Yep.
And your broker might say, you got to be done by 2:00. And the other broker might say, if you're not done by 3:00, I'm going to do it for you.
Right.
You have to have this conversation with your broker about what their policy is for them being the broker who's a member of OCC, and we're going to get to OCC in a minute. I think
yes.
They have what's called a window. The window at OCC to deliver exercise notices is open for them until 5:30 p.m.
Right. So that's the latest. Now, a broker cannot relax a rule, but they can make it stricter. So if you're ever in doubt, I actually think it's a good idea. You can probably find it on the website. Type in your broker's name on Google and type exercise
policy.
Exercise policy would be
notice time.
Yep, and they should have all of their policies in there.
Yeah.
Right. So make sure you understand that. Now, it's also important to understand that exercises may create taxable events.
No, we're not your tax guys.
We just want to let you know that it could trigger that. So
right,
just be,
right. That's
be aware
our
of that.
Disclaimer here is we're not your tax people, but what we are telling you is if you do take delivery, it may trigger a taxable event for you.
Yep. Or if you exercise a put and deliver your shares to somebody.
Yes.
Right. Now, most brokers won't allow you to exercise, especially if you're going to take delivery, unless you can meet margin requirements. So just because you say I've got 10 call options doesn't mean you can click a button and take 1,000 shares of Microsoft. You need to be able to meet at a minimum the margin requirements for that, which in most cases is going to be 50%. So just don't be shocked.
$379 on Microsoft. So, times 1,000, that's going to cost you that much money.
That's right.
And then half of that you'll have to put up in margin if you're on margin, which is a lot different than owning 5 calls at $800 each, which would be, $4,000 or $5,000.
Yeah. Now, a lot of people don't recognize that technically speaking, options are actually really technically speaking, they are marginable, but they have to be 9 months or more. However, you won't find a broker anywhere in the world.
Nobody margins.
That's going to margin them.
Cash.
But they're considered to have a 100% margin requirement. So if you buy one contract at $5, that's $500. You got to have $500 either margin cash available or actual cash to buy it. So just kind of keep in mind, those are some of the ideas behind a long option. Now, what about the shorts? Again, the short options can get assigned at any time, assuming we're talking about American style, which for the stock market in most cases will be. You could get assigned at any time. So again, you've got this option that's got 30 days to expiration. It's 10 cents out of the money, 75 cents out of the money. Could you get assigned? You could.
You can get assigned.
You could.
Now, keep in mind that in order for you to get assigned, somebody has to exercise.
Correct.
You can't just get assigned because nobody exercises. Somebody has to exercise.
Somebody had to. Yep.
And then we go through the process. And I think, Bill, we're going to talk about that process a little bit, but you kind of go through the rigmarole and you could get assigned.
Yep. So the short positions, as we mentioned, have obligations. And again, assignments may also create taxable events. So let's take a look at it graphically here, guys. Let's take a look at exercising calls. Let's say that we're long. Let's make it one Microsoft call. We exercise it. How much is it going to cost us? $35,000.
35,000. Right.
Click on exercise, so to speak, and we're going to have $35,000 come out of our account. And it's going to get assigned to another trader. We'll talk about that in a moment, how that's done. But for right now, just take it that somebody gets picked. Obviously, somebody who is short the same contract. So what's going to happen here? Well, they get an assignment notice. You log into your account one day and there'll be a little pop-up menu. You got assigned. That's what an assignment notice is. And they're going to say, we're just letting you know that we took 100 shares out and we've delivered them. They're not there to ask you to please make sure you deliver the shares, or do we have the right to take them? They're just going to take them.
They're just going to take them. And that process, by the way, that process happens overnight.
Yes.
Overnight. And you get your notice of assignment
the next day.
The next morning. Prior to the opening, you will get what's called an assignment notice.
Yep.
Even if somebody exercises their option, like 12 o'clock in the afternoon on
the day before. Yep. You won't know it.
You won't get your assignment notice until the following morning.
Right. Now, typically, if you close it before that day, you're usually going to be out of the pool. But if you didn't, you could be the one who got picked, even though somebody exercised it at noon the day before.
Yeah.
So this is kind of the...
It will not have settled yet, Bill. And, when we used to do those div swaps, we were buying and selling. I might buy and sell 10,000 contracts on the same day, close them up, however, and exercise, but I was still part of that pool. So you're actually still in that assignment pool.
Okay. Yeah. Oh,
if you bought it and sold it on that same day. But typically, if you do close it, you will not be
correct.
You will not be in the line of fire.
Now, one thing to also notice here, a little side note, take a look at what happens if we exercise this call. What did we do? We bought 100 shares of Microsoft.
You did. And you lost the call.
And if we sold the call, what happened? Well, we bought 100 shares. I'm sorry, we sold 100 shares of Microsoft. We're just buying and selling shares of stock. So this is another reason why it's not true when everybody says that, oh my gosh, options are so risky. They can be used in risky ways, but ultimately, it's just a right to buy or an obligation to sell. That's all it is. Now, let's take a look at exercising puts. This time we got the 350 puts. We push our exercise button. What happens? Somebody somewhere who is short the same contract, same underlying and same expiration month and same strike is going to get an assignment notice. What happens? They are going to have $35,000. That's the strike times 100 taken out of their account. What do they collect? 100 shares. They
got to pay for it. Is another way to say
they got to pay for it, but they pay the strike price.
The strike price.
Yeah. So it doesn't matter if Microsoft's at 370 or 400. Their locked in price for the buyer over here is 350, and the obligation is at 350.
Or if the stock is 320, you just paid 350.
Exactly, which is why you typically aren't going to see it exercised. But we always want to make sure that people understand that it can happen. Mm-hmm. And we'll talk about some reasons why it might as well. Now that we've covered that background, let's get into what's probably the official start of this program and what we really wanted to highlight, and that is automatic exercise. There is a process out there in the markets that is called automatic exercise. The technical name is exercise by exception. And how does it work? All options that are at least 1 cent in the money will be automatically exercised. Now, remember, this is for the long options.
So the exercise by exception would actually be the one that's out of the money, right? Because if it's in the money by a penny or more, it would be that's getting automatically exercised.
Right. But that is the exercise by exception.
The exercise. Go ahead.
The exercise by exception is going to be that they're going to exercise if it's at least 1 penny in the money.
No, that would be the auto exercise.
It's the same difference. Exercise by
1 penny in the money is an auto exercise. If it's right on the strike, it's not an auto exercise. And they would want to exercise anyway, so it would be an exercise by exception.
Okay. But
No?
you're always allowed to submit do not exercise instructions. So let's say that maybe you saw your call option was out of the money, slightly out of the money. You go into the closing bell, expiration day, and it's now in the money. And you go, oh my gosh, I'm gonna go through Auto X, and I don't want to do that. It's your right. You can call the broker and say, hey, I don't want to exercise. But keep in mind, you don't get forever to do it. You can't call on Saturday or Sunday or next month and say, I didn't want the exercise. You need to catch that as it's going into the close on expiration day. So prior
to the depending on what their policy is, but maybe 5:30 or prior to 4 or 3 or 2, you'd have to issue that. Yes.
Yeah. Part of the moral of that story is that you need to watch that on expiration day. See if you have any options that are expiring that day. All right. Now, let's take a look at how this process happens. A moment ago, we looked at some demonstrations where I said somebody gets assigned. So how do we figure out who gets assigned? Well, this is where the Options Clearing Corporation, the OCC, comes in. And it's
time out 1 second.
Absolutely.
We go back one frame. Here you are out on the golf course on the 17th hole, and you check out your phone and you see the stock's trading at 49.89.
Mm-hmm.
And you're long the 50s, and you say to yourself, they're going out worthless, forget it. And lo and behold, while you're putting on the 17th hole, the stock closes at 50.05. They are exercising your option.
That's right.
Right?
That's
an automatic exercise. The threshold is 1 penny. 1 penny. Used to be a quarter, and then it was, kind of kept coming down and down. Now it's a penny. So anything a penny or more in the money is going to get it. And you're going to come in long
on Monday morning.
That's what you thought was an out of the money option that you owned, which was going out worthless.
That's right.
What a big change in risk profile that is.
Oh, yeah. Yeah. So this is, again, why you have to be very careful on expiration day. The best way to avoid that is to do what? Just close them.
Not have the position.
Most brokers will let you close them if it's a long position for usually just the not counting the commissions. They do it for like a
nothing. It's cabinet
for next to nothing, and it's just to get the risk out of there.
Mm-hmm.
Now, the short position, some brokers will still charge you because they know that you had to close it anyway. But again, check with your broker's policy. Now, let's take a look at the OCC. Again, it's a highly capitalized and regulated clearing firm, and it acts as the buyer to every seller and the seller to every buyer.
Yeah. You mean you and I don't actually trade with each other, Bill?
Yeah, I know. It's kind of funny that we talk about that, and I know you guys probably I do it all the time, and I'll say, well, the trader on the other side, if I buy a call, I say, well, the trader on the other side, meaning that maybe it's Scotty, maybe it's Stu. Somebody somewhere is on the other side of my trade, and that's not really true. We do that just to give people a nice visual of what's happening. So the problem with being assigned to one specific person, what if that person defaults? How do I know that that person's good for it? But by having a clearing firm, it doesn't matter because they act as the buyer to every seller and the seller to every buyer. Here's an interesting stat. Since 1973, when options first traded, not a single default has occurred from exercising options. That's remarkable.
Yeah, I was gonna bring that up. That's
remarkable.
100% accurate. Not one contract.
Not a single time.
It must be hundreds of millions.
Oh gosh, what would be the dollar values there
of contracts that have traded? Astronomical. Not one single contract. Now that doesn't mean that the person on one side or the other didn't go bust.
Oh yeah, no, right. That doesn't mean they're profitable. That just means the exercise went through.
The Options Clearing Corp guarantees every contract. Every brokerage firm is a member of Options Clearing Corporation. That's what makes up Options Clearing Corporation, all the member firms.
Right. Yep. So they have to make sure that all of the traders, let's say if they're selling the calls, that they either have the margin requirement or they have the shares in their account. They're monitoring that for you. Mm-hmm. So here's the way that it works, just to give you a little more confidence in an exercise. Let's say that we exercise the ABC May $100 call. What do? We push a button, call the broker, whatever. We get exercise instructions. That goes to the OCC. We are going to get debited for $100 cash, or 100 per share, $10,000 total. What does the OCC do? It's going to notify, it looks at a pool of all of the member firms, and it's going to pick one by a random assignment. All right, so let's just say that we've got E-Trade and Schwab, Fidelity, Merrill Lynch, and it picks one. Let's say that they just happen to pick E-Trade. The important point is that it has to be done by a random assignment. Now, E-Trade does a similar thing.
So they say.
So they say. They can also do it by a first in, first out, a FIFO method. But the point is they can't just pick on one person and select or do it as a favor. It has to be some type of a random process. And now this person gets assigned. So here's Trader Joe up here, and Trader Joe gets assigned. He's going to get the $100 cash, or $10,000, and he's going to lose the 100 shares, and that's going to come over to you. So that's how we know that an exercise is going to go through. So that's a little bit of the background to give you a little confidence in it. Now, another important part about exercises and assignments. I know you guys get lots of questions on this in coaching, but you have to understand the resulting risk graph. So here's our long call, right? Our little hockey stick shape. What's going to happen to this risk graph if we exercise it, guys? What happens to our graph?
Well, I think the curve goes away.
The bend is going to go away because we are long 100 shares of stock. We're long the stock. So you're going to move from the black, which relatively speaking is safe because we've got this limited risk to the downside.
You kind of think of your new strike price as a zero.
Yeah. And so now if you buy 100 shares at 100, you're going to cross right there at 100. You could also say it's at 105. If you paid 105, you could say your cost basis is 105. But the point is, you go to a straight line. And if you think about it, one of the main reasons for being on the black line or buying the call is to get rid of this. But when you exercise it, you're doing the opposite. You're inviting that. You're actually opening up the downside. So just be very aware that when that's a simple example of exercising a call, but if you have multiple positions that you're exercising, understand what it's going to do to you for the entire portfolio, because it is going to change something. Mm-hmm. Okay, what about auto exercise danger? Long options can lose more than the amount paid. This is another thing that most people don't understand.
I always read that you can only lose what you buy it for.
Yeah, that just means that the option itself cannot have negative value. But again, the way that can happen is through auto exercise. So let's say that the stock is near the expiration bell again, trading at $99.90. You own the $100 call. Stock closes at 100.01 or higher. Monday morning, what happens? You own 100 shares.
And what,
let's say,
according to Mr. Murphy, what happens?
Mr. Murphy's going to enter the picture right here, and that the stock's going to gap down because there was a big earnings announcement and the stock is down 30%.
There you go.
So you paid maybe $200 for this call, bought 10 contracts. You say, the most I can lose is 2,000. But now you're long a bunch of shares.
You're long 1,000 shares, down 10 points.
You're long 1,000 shares, or however
a lot
many,
more than $2,000.
Whole lot more than $2,000. So that is an instance where you can lose more than what you paid. Now let's talk about this too. Scotty, let's back it up. Same idea, but the stock closes at, let's say it's expiration day and it's, stock is 100.90. All right. I'm sorry. Is 99.90. Back here, what we talked about.
Technically, the option goes worthless.
Why might you still get assigned?
It's very, very rare. It would be a rare occurrence.
It is rare.
Very, very rare, but it could happen. Who knows why it happens? Someone made a mistake. They fat fingered something.
Could be.
It could happen. It definitely could happen. So
what could be a reason where
all this hinges upon not doing anything until the very last moment. You should never find yourself in that position. You should be closing out before you go to the golf course. But if you are, for whatever reason, holding down to the wire, if your option's out of the money, like you said, Bill, still could get assigned. You could.
There's no reason to really exercise early, which is why, again, there's usually not a big difference between the American and European style, because you're locked in. In this case, you are always locked in at 100. So there's no real rush. But Stu, what's another reason why you might get assigned, even though the stock might close at $99.90?
Yeah, maybe it's trading at $106 in the aftermarket.
Yeah, that's what I was saying. You might have earnings that get announced, and it's now trading up above there. So you look at it, you're on the golf course.
Even though you're looking at the New York close or the NASDAQ close and see $99.90, it's trading at 107 or 110 or 130. Right. Or in the case of Palo Alto, not this past earnings, but the earnings before, and I kind of forget the numbers. I think it was around 217.
We're going to talk about that in a second. Hold that thought.
And now on expiration day, it's trading, significantly higher. You might be short the out of the money call. Are you getting assigned? Yeah,
you might.
You're getting assigned, right? Because the other side's paying attention, and they know that they have $10, 20, 30, whatever it is, dollars of intrinsic value left in that option. They're not going to leave it on the table.
Oh, we've even talked about what else could you do? Short the stock and exercise.
Absolutely.
So there's no real reason to not take it. You are most likely going to get assigned. So here you are on the golf course, cheering that your option expired out of the money, your short call for your covered call.
Yeah.
And then this is where traders go, oh, but they're not allowed to exercise it because it closed below 100. Not true. They can exercise it at any time for any reason.
Anytime for any reason.
Including that it gapped up in the after hours, right?
Even after the bell.
You got till 5:30. So there's a real good example where people get caught off guard. Now, Stu, you just happened to bring up, I was thinking the same thing here. I think we were talking about this in Q&A the other day.
Yeah.
Palo Alto, PANW. Now, I know it's a little hard to see, but we put this screenshot in here just to show that we're not making this stuff up. But the stock right there is at 207.57.
Now, this is expiration. Correct me if I'm wrong, Bill. Expiration Friday.
Expiration Friday. Market is closed.
4
Options
o'clock.
Market is closed.
Is closed. Okay.
What's the straddle going for?
Well, it looks to be about $11.
11.30 to be exact.
But it doesn't extrinsic value go to zero on expiration?
That's something that we hear, that extrinsic value goes to zero at expiration.
Right. So what's the point here? What
happened? How come the straddle was holding $11 of extrinsic value?
So if you're short an option,
what was coming out after the bell?
If you're we had earnings. We had
earnings, right?
It doesn't really happen too often that they're going to come out Friday on expiration after the bell, but it does happen. Right.
Yeah.
So, and you're the one standard deviation is $11 here, up plus or minus. You're short a call, or you're short a put, or maybe you're short both. How do you know you're not getting assigned? You're just sitting here, like licking your chops, collecting your $5.50, and lo and behold, the stock's trading at 240, and you're getting assigned on your 207 call, which you think you're collecting all this money on. Right.
Or you sold this at $10 during the day, going, I've only got one day, it's going to go to zero.
Yeah.
On the closing bell, and it's still trading at 11. So this is a really good example where I would classify this as a risk premium, or maybe a convenience yield in the futures markets, where people were willing to put a price on it, even though technically the option has expired, because they still have until the 5:30 window.
Scotty, have you had any clients where they were short a call or a put, and they got assigned thinking that their option was out of the money and they were going out worthless?
Most are not holding prior to expiration.
To Friday expiration, yeah.
Like you're saying, the market's implying the volatility after hours into the option, so it sticks.
Right. Or not even. Maybe they're like, zero. And they're thinking they're going to be going out worthless, and they go out worthless, but they got assigned. Have you had anybody that happens to?
I don't have necessarily a story, but certainly this occurs on aggressive growth stocks prior to earnings. That vol can be really sticky.
I'm going to give you I'm going to give everyone the 30-second version of that story. So this is a real life story. Client A had a short put on the 400 line in XYZ stock. The stock was 418 on the bell, closing bell, 418. 18 points out of the money. He got assigned. He or she got assigned.
Yep.
18 points.
18 points
out of the money.
Yep.
18 points out of the money. Gets his notice Saturday morning. The stock was trading after hours, $3.95. There was $5 of intrinsic value in that option. You didn't know it if you didn't know how to read it because it wasn't being shown to you. The option market was closed.
Right.
So who knew, right? But, look, we're options traders. We're supposed to know that. Where did the stock open the fund? And the guy got assigned. And he gets assigned and he buys 1,000 shares at 400.
Yep.
Where did the stock open? 356.
350. Wow.
Right? Do the math. It's a lot of money. It's a lot of money. And this is why you gotta, you gotta understand the process. Pennies, and you're just getting, oh God.
Yeah, you gotta understand the process. So again, for anybody who might be new, check out marketrebellion.com/get started for some great trading videos and articles out there. Now, I thought let's close up with, I know there's a lot of different scenarios with debits and credits and calls and puts and things, but let's look at a case where what I wanted to show here is that it's not necessarily a risk to get assigned early. In some cases, it is, and in some cases, it isn't. And that's why you have to understand as a trader, what are you trying to do, and is it really going to create a risk? So let's check this one out. Let's say we have a debit spread, and we're going to use it with calls. We buy the 100 call, we sell the 105. Let's say it's for a net debit of 3. That just means that's the net cost that we pay between those two options. So maybe we spend 10 for this one, we collect 7 here for anybody who might be new. And that's where that net of 3 is coming out. Now, if we do that, this is the resulting risk graph. Notice that we get our bend at 100. We get another bend at 105. These are stock prices across here. And you can see that the maximum loss lines up right there at -3. That's the worst that can happen. The best that can happen is that you make 2. And that's because you have the right to pay 100, obligation to sell for 105. That's 5 points minus the $3 you spent, puts 2 in your pocket. Now, we've had many traders, and I'm sure you have too, Scotty, where people say, oh no, I'm so afraid I'm going to get assigned for whatever reason. This option's now in the money. I'm afraid I'm going to get assigned. And so they close out the position. Well, is it really a risk? Well, let's take a look. If the long position exercises, short position gets assigned, and we're trying to figure out, is it a risk? So here's your long 100 call. There's the short 105.
Scotty, if you have this position on and you get assigned on your 105, are you happy or are you pissed off?
Oh, I'm happy. As long as the bid-ask spreads aren't extraordinarily wide, that's a favorable, that's a favorable outcome.
You are jumping for joy that you got assigned.
So take a look here. If you get assigned here, what happens? You are going to be short 100 shares. And so when we put those together, long call, short shares synthetically is a long put. So what it does is we switched from that risk graph that we saw in black to this one in red. And take a look. We've hit our maximum gain guaranteed. That is now the worst that can happen.
Yeah.
And yet we still might make more.
See, now you're short the stock and you're long the call. The stock could go down forever and the call is going to stop going down at 0.
Yep. This maximum 3 loss, gone.
Gone.
The maximum gain of 2, guaranteed.
Right. And
the debit spread, it locks in the cash. You will unlock the gains, and you will reverse the directions. So for a debit spread, bring on the assignments. That is nothing you should be fearful of. Credit spreads will unlock the gains, but they will not. They'll give you unlimited gains, but they will not lock in a guaranteed gain. And that's because it's a liability spread instead of an asset. But here's a really good example where traders get really freaked out for certain strategies, and they say, oh, I'm so afraid I'm going to get assigned, so I closed it out. That's the best thing that could happen.
Yeah, just look at what you have and look at what can happen once you have what you have, and you'll find that that assignment might have just created an unbelievable opportunity. In this case, should the stock crash and go the other way, you have a synthetic put.
Yeah,
you'll get them coming and
going. Free. Look at it as like a free lottery ticket. They gave you your $2 guaranteed, got you out of the deal, and they said, "Hey, by the way, we're going to throw in this free put."
Yeah, assuming that the extrinsic value or the delta on the extrinsic value is like close to 0 or 0 on the 100, or you could say the delta is close to 1 or 1, which is a pretty good bet since you're getting a sign on the other one.
Yep.
Right, 5 points further away. That's a pretty good bet. So short the stock, long the call for nothing, on the put for synthetic put for 0, and bang, you got downside opportunity, unlimited opportunity. Should the market say, "Hey, we made a mistake,"
turn around and reverse on you. Yeah, that's a beautiful thing. So there's a real good example. If you thought that this was a risk, it shows you're probably missing a lot of opportunities in the market.
Yeah.
So those are some of the basics that we wanted to really highlight with people and some of the new traders out there, just about the mechanics of exercises and assignments. There's a whole nother topics we can talk about. I know, Scotty, we were talking about doing it for cash indexes. Maybe we'll do that next week. Look at the something like an OEX, an American style cash index, and show some of the problems that can arise there. But again, most of your products that most of you are trading are going to be stocks, ETFs, ETNs. They're going to be American style. And so hopefully that gives you a better understanding of exercises and assignments. So with that, let's go back to our chalk talk. What was our question here, Stu? Stocks at 99.90.
Something about getting assigned.
You're short the 100 call. Will you get assigned?
Maybe.
What do you think?
Maybe.
What would you say, Scotty?
Oh, I would say unlikely.
It is unlikely, but if somebody asks you that as a coach, I think the better answer is
you could be assigned. There's a chance.
We don't know. There's a chance.
There's a chance.
Yeah. You could get assigned. Right?
Most people would look at this and say, no, you can't, because it's out of the money. That's kind of where I was with this question. That is not true. If you have an explosive, let's say earnings, FDA announcement, something that comes out and the stock's trading at 120, even though there's 30 days to expiration, what's likely to happen? They will short the stock, exercise the call, and grab the 30 points. So we don't really know. But I do agree with you, Scotty. If there's no news, no earnings, nothing else, it's virtually not going to happen. But the thing is, you don't know. And this is, so the whole moral of the story is that if you are trading options, you need to understand the mechanics of options, especially exercises and assignments, and also your strategies. So hopefully I'll give them some things to think about. Any closing comments? Stu, let's start with you.
If you have an out of the money credit spread on going into or close to expiration that's trading at nothing or next to nothing, highly consider taking it off.
Shut her down.
So you don't get stuck in a potential assignment that you don't even know is coming.
Right.
And even if you did know it was coming, would you go ahead and exercise the long part of it and kind of lock in that what looks like a loss in order to cover your down? It's so messy.
It is.
It's not worth it. Just unwind it, donate the couple of pennies to the marketplace and move on with your life.
Absolutely. Scotty.
Yeah, I wouldn't say that I make my students do 50 push-ups if they don't close their short options before Thursday or Friday, but I try to encourage them to close things down prior to
I would
Friday
agree.
morning.
It's hard to say a definitive rule that you never do it, but I think it's good to at least say consider it. And here's why.
Consider the risk, consider the rewards. What can you make? What can you lose?
Yeah, you can always set a buy, you can always set a buy stop on a short option at 10% of the value of what you sold it for, and it's automatically working. Takes the question, the emotion out, and it's happens. That way you don't talk yourself into holding onto that last 10 cents all the way through Friday.
Right. Mm-hmm. Takes you out of it. So anyway, we hope that helps you to understand some of the nuances of exercises and assignments, understanding where In case of a debit spread, it's actually a good thing if you get assigned early. And if any of those things sound mysterious to you, it could be a very good clue that you need coaching, and you're going to have two of the best right here. If you want to give us a look up at marketrebellion.com. And with that, I want to thank
real quick here.
Sure.
I'm just kind of taking a look at Tesla. I know we're going over here dramatically. I'm just taking a look at Tesla. Tesla closed at 240 spot 08.
Okay.
Yeah. Let's just make pretend for a second today was expiration, and I'm short the 240 puts.
Right.
Closed at 240.08. I think I'm home safe.
Right.
It is currently trading at 233.65.
There you go. 7
I'm
points.
getting assigned.
Yep.
I'm going to count. I may leak, but I'm counting on getting assigned. If I'm short the 235s or even the 237.50s,
yep, you're
counting on getting assigned.
Yep, you're going to be long on Monday morning, and you can't call a broker and say, I don't want to get assigned, because that's not a right. You're on the short side. You have no choice.
Yeah, you have an obligation. You're part of what's known as the open interest pool.
Yep.
Yeah.
You have no choice.
Okay.
So anyway, again, if that sounds like some things that are new to you, please give us a shout. You might want to line up some coaching sessions with Stu or Scotty, and we'll look for you next week. And I think let's do that, guys. Let's do the American style OEX.
Yeah.
It'll be a little bit of a follow on for this, and we hope to see you then. Thanks so much.
See ya.
Thanks, everyone.